Okay, so you want to own a data center. You picture it. A long, low, windowless building at the edge of a highway. No sign, no customers. Just a fence, a gate, and a row of gray boxes humming out back. Inside, cold air, blue LEDs, aisle after aisle of racks working for somebody, 24 hours a day, forever. Nobody shoplifts. Nobody complains about the parking. Your tenants sign 15-year leases and never leave because leaving would mean switching themselves off. It looks like the cleanest business in real estate. A warehouse full of machines quietly paying rent while you sleep. That's the picture. That's what the pitch deck sells you. Here's what the pitch deck doesn't show you. That anonymous gray box you could drive past without noticing is the most expensive building on Earth per square foot. More per foot than a hospital. More than a skyscraper. And the building is not the reason. The concrete, the steel, the roof, the walls. That's the cheap part. Read that again. On the most expensive building in the world, the building barely matters. Sounds simple. It is not simple. Because you are not buying square feet and you are not really buying racks. You are buying electricity and somewhere to put the heat. Every dollar in this business flows from that one fact, including the dollars that are about to disappear. Start with the unit because the unit tells you everything. Nobody serious in this industry prices a data center by the square foot. They price it by the megawatt. A megawatt is 1,000,000 watts of usable computing power, roughly the electricity of 800 American homes, poured into a room the size of a couple of tennis courts. Right now, the benchmark to build 1 megawatt is about $11.3 million. All in. Land, shell, power, cooling, fit out. So a modest 100 megawatt campus, man, 100 megawatts is not big anymore. It's ordinary. Costs you $1.13 billion before a single customer plugs anything in. Now look at where that money goes, because this is the part nobody expects. The land is close to a rounding error. The shell, slab, steel, roof, walls, the thing you'd actually call the building, is maybe a fifth of the budget. Around 45% of everything you spend is electrical. The substation, the transformers, the switchgear, the uninterruptible power supplies, rooms full of batteries, and a line of diesel generators outside the size of shipping containers. Another quarter is cooling, so roughly 2/3 of the most expensive building in the world buys equipment that computes absolutely nothing. It just moves power in and heat out. And 11.3 million is the boring version, built for AI, where a single rack pulls 120 kilowatts instead of 8, where air physically cannot carry the heat away anymore, and you have to run liquid coolant directly across the chips. And the number climbs to 15, 18, 20 million a megawatt and keeps going. Then you pick a tier, and the tier is really a promise about failure. A tier 3 facility guarantees 99.982% uptime. That sounds like perfection. It's about 1 hour and 40 minutes of darkness a year. Tier 4, everything doubled, 2 live power paths, fault tolerant, the kind of building a bank's core ledger sits in, guarantees 99.995%, 26 minutes a year. Those 26 minutes cost you 30 to 50% more to build, and that is the whole business in one line. Nobody is paying you for the computer. They are paying you for the promise that it never ever stops. Now the thing that will actually stop you, and it isn't money, it's the wire. You can have the $1 billion, the land, and the permits, and still not be able to build because there is no power to be had. In Northern Virginia, Loudoun County, Data Center Alley, where something like 70% of the world's internet traffic passes through, the utility simply ran out of headroom in 2022 and told new customers in writing that it could not connect them for years. Getting a place in the grid queue in a hot market now takes 4 to 7 years. A large power transformer, which is essentially a steel box full of copper, has a lead time of 3 to 5 years. Backup generators too. Switchgear a year and a half. So here's the first reversal. The scarce thing in the most capital-intensive building on Earth is not capital, it's a place in line, which is exactly why finished, powered, permitted capacity almost never sits empty. Vacancy across North America is under 2%, and most new capacity is leased before the concrete is poured. You are not building for a market, you are building for a tenant who is already begging. So let's talk about who pays you and how. Layer 1, wholesale. You lease big, 5, 10, 50 megawatts megawatts at a time to one hyperscaler on a triple net lease running 10 to 15 years, priced per kilowatt per month. Call it $110 to $150 a kilowatt. 1 megawatt throws off roughly $1.5 to $1.8 million a year, and the tenant pays the power bill and most of the operating costs directly. It's boring. It's investment grade. It's basically a bond with a roof on it. Layer 2, retail co-location. Instead of one giant tenant, you sell cabinet by cabinet to hundreds of small ones. A hospital's record system, a bank's disaster recovery, a game studio, a trading firm that will pay a premium to sit 10 feet closer to the exchange. More work, more staff, far better pricing, often $200 to $250 per kilowatt per month, and more in a starved market. Layer 3, the power itself. You buy electricity wholesale and resell it. The margin per unit is thin, but a megawatt burning around the clock consumes about 11,000 megawatt hours a year, and a small markup on 11,000 of anything is real money. Layer 4, remote hands. Your customer is in Singapore and a drive fails in Ohio at 3 in the morning. Somebody has to walk down the aisle and swap it. That's $200 an hour with a minimum charge, and they cannot say no. And then layer 5, the one that explains this entire industry, a cross connect. It is a piece of fiber optic cable, maybe 50 feet long, running from one customer's cage to another customer's cage inside your building. It costs you almost nothing. It has no moving parts. It will never break. You charge $200 to $300 a month for it every month forever. Equinix, the largest retail operator on the planet, has more than 400,000 of them. Do that math slowly. 400,000 strands of glass at roughly $3,000 a year each. In a building that cost $11 million a megawatt to construct, the single most profitable product is a wire you could carry in one hand. And it's better than profitable, it's the moat. Once 300 networks are in your building, network 301 has to come to you because that's where everyone already is. And none of the 300 can leave, because leaving means unplugging from everyone else. Your customers built the trap themselves. They pay you rent to stay inside it. Blend all 5 layers at the top of the retail market, and a single megawatt can gross around $4.4 million a year against $11.3 million to build it. That is a genuinely excellent business. Stable, boring, compounding, dull as a stone, which is precisely when somebody offers you $60 million. Same megawatt, same room, same square footage. But instead of renting out the space, you buy the computers yourself and rent out the computing. Fill that megawatt with the current generation of AI accelerators, and at peak pricing, it can bill up to $60 million a year. 13 times the boring number from the same patch of floor. Read that again, then read the sentence after it, because it's the whole video. To collect that $60 million, you first had to buy $30 to $40 million of chips per megawatt. You didn't become a landlord, you became the tenant. You just bought the part that wears out. Before the wearing out, the leaks. Power is the monster, not the power your customers use, the power you waste. The industry measures this with a ratio. For every watt that reaches a chip, how many watts does the whole building consume? The average facility runs around 1.5. Half of everything burned on cooling and conversion losses before a single calculation happens. The best hyperscale sites get that near 1.1. That gap is not a rounding error. On 100 megawatts, it is tens of millions of dollars a year, decided by how well you designed the airflow. Then water, because most cooling is evaporative. A large campus can boil off millions of gallons a day, which is fine until the county notices. Then property taxes, which would be crushing, except that states desperate for the jobs hand out exemptions on the equipment inside. That exemption, not the building, is the actual subsidy. Then maintenance. You test the generators monthly. You pull the entire building onto diesel, and every single test is a chance to discover the failure you spent $1 billion preventing. And then payroll, which is the strangest line on the sheet, because there almost isn't one. A 100 megawatt facility might run with a few dozen people. A shopping mall of comparable value employs 3,000. This is $1 billion business with the staff of a mid-sized restaurant. Labor is not your problem. Nothing here is your problem, except the one thing. Here's the structural weakness, and it belongs to this business alone. You have built a 40-year building around a 4-year asset. The shell will stand for 40 years. The electrical typical plant lasts 15 to 20. The chips inside, the only part actually earning the 60 million, are economically old in 3 to 5 years. Not broken, not smoking, just beaten by something faster that does the identical work for a third of the electricity. And the price of compute does not drift down gently. It falls off a cliff. Top-end AI chips rented for around $8 an hour in 2023. By 2025, the same hardware was going for around $2. 75% of your revenue gone in 18 months, while your depreciation schedule, your debt service, and your power bill did not move a single cent. Which brings us to the number the whole industry is currently arguing about: depreciation. Spend $30 million on chips, write them off over 5 years, and that's $6 million a year of cost per megawatt that never shows up as a payment and eats your earnings alive anyway. In the first quarter of 2026, industry AI revenue crossed $25 billion for the first time, a genuine milestone. Depreciation on the equipment producing that revenue was about $21 billion. Read that again. The business finally sold $25 billion of artificial intelligence, and the machines making it wore out by 21. So watch what happens next, because it's elegant. Every major operator has, over the last few years, quietly extended the assumed useful life of its servers. 3 years became 4, 4 became 5, 5 became 6. Each extension shrinks annual depreciation and inflates reported profit without selling one extra thing. Michael Burry, the investor who shorted the housing bubble, pointed at exactly this in late 2025, called it one of the more common frauds of the modern era, and estimated the big spenders would understate depreciation by something like $176 billion across 3 years. Maybe he's right, maybe he's early, but notice what the argument is actually about. Not whether the chips die, only how slowly you're permitted to admit it. Which brings us to a company that ran this experiment in public. CoreWeave started in 2017 as a crypto outfit called Atlantic Crypto. A handful of guys in New Jersey with graphics cards mining Ethereum. When crypto turned, they were left holding a warehouse of GPUs and nothing to do with them, so they started renting them out. Then AI arrived, and by pure accident, they were standing in precisely the right room at precisely the right moment. Revenue went from $229 million in 2023 to $1.92 billion in 2024, 8 times in 1 year. In March 2025, they went public at a valuation around $23 billion. A garage crypto miner worth more than most airlines. Now the part that matters. To buy the chips, CoreWeave borrowed billions and pledged the GPUs themselves as collateral at rates that started north of 14%. Sit with that structure for a second. You are borrowing long against an asset that loses most of its earning power in 4 years to serve a market whose prices fell 75% while you were still building. And the majority of the revenue came from a single customer, roughly 62% of it from Microsoft. Despite all that growth, the company lost $863 million that year. That isn't a knock on CoreWeave. It's the honest shape of the business. Every megawatt of AI compute is a bet that revenue outruns depreciation. Make that bet with borrowed money against collateral that melts, and you don't just have to be right. You have to be right on schedule. So where does this go? Straight into the wall it was always going to hit. The constraint has moved off the balance sheet and onto the grid. Gas turbine manufacturers are effectively sold out to the end of the decade, so the industry stopped waiting politely for the utility and started buying power plants instead. Microsoft signed a 20-year deal to restart 3 Mile Island. Yes, that one, the site of America's worst nuclear accident, to feed data centers 835 megawatts. Others are bolting gas turbines directly onto their campuses and skipping the grid entirely. Others are promising small modular reactors that don't yet exist at commercial scale. Look at what that means. This stopped being a real estate business. It's an energy business that happens to own some buildings, which is why the smartest money isn't shopping for data centers at all. It's quietly buying substations, land beside transmission lines, and positions in the interconnection queue. Now zoom out, because we have seen this shape before. In the late 90s, companies borrowed staggering sums to bury fiber optic cable across the world because everyone knew the internet would need it. They were right. Global Crossing spent something like $15 billion and went bankrupt in 2002, with barely a few percent of its fiber ever lit, but the cable stayed in the ground. Somebody bought it for pennies, and that glass carried the next 20 years of the internet, with streaming, the cloud, all of it. The infrastructure won completely. The people who paid for it did not. So here's what you're actually buying. It looks like a building. It isn't. It looks like a room full of computers. It isn't that either. You are buying a place in line for electricity and then wrapping $1 billion of concrete and copper around a pile of silicon that begins dying the day you switch it on. The boring Megawatt pays you $4 million a year and asks nothing of you. The exciting Megawatt pays you $60 and demands that you be right about the future. On a 5-year clock in a business that takes 7 years to plug in, the building will still be standing in 40 years. That was never in question. The only question is whether it will still be yours.